Investors Chronicle.
Hello and welcome to the IC Interviews podcast. I'm Val Cipriani, personal finance editor at Investors Chronicle, and today I am joined by Guy Anderson, manager of the Mercantile Investment Trust. So Mercantile invests in UK quality mid-caps with a focus on looking for companies with strong cash flows that can help the trust grow its dividends ahead of inflation over time. Now, like many funds investing in UK mid and small caps, Mercantile has struggled a bit during the 2022 sell-off and for a good part of 2023, and then has staged quite a recovery over the last 6 months or so. So Guy, thanks for coming on the podcast. How are you doing?
Hi, thank you for having me. Very happy to be here.
So let's maybe start by talking about UK mid-caps at the moment, because I think they have been a bit of an unloved area in the past few years or so. But then I was having a look at Mercantile's gearing, and it's in the region of 14% or so, which kind of tells me that presumably you must be feeling quite bullish towards the sector. So, is that true? And if yes, why? What is attractive about it at the moment?
Okay, brilliant. And yes, the answer to the top question is yes, we are feeling pretty optimistic about the outlook today, and you can see that in our gearing, which is clearly elevated relative to history. If we step back for a moment, I think if we take a sort of long lens view, UK mid-caps have been a really attractive place in which to invest. And if we think about the last 30 years, for example, they have compounded at about 10% per annum, which is it's quite a long way ahead of, say, the FTSE 100, the large cap index, which is annualized more like 6%. And over the long term, that's due to the superior growth delivered by smaller companies relative to larger companies. But you're absolutely right. When we zoom in on the more recent history, it's been a little bit trickier, should we say, at the mid and small end of the market. And clearly, smaller companies do tend to be more cyclical. They are more impacted by what's going on in the economic cycle, and that has been somewhat more challenging of late. But the reason why I think it's particularly interesting today is there's a sort of confluence of factors at play. So first of all, I think the long-term drivers of outperformance of mid and small cap companies remain in place, i.e. their ability to drive superior growth. But what's really interesting about it right now is that the perception is very negative, because the perception is that the UK is experiencing significant economic malaise, I think it would be fair to say. And as a result of that negative sentiment and the negative narrative, UK valuations in aggregate are trading at very low levels relative to history, both in terms of the UK's own history, but also relative to other developed markets. And then within the UK itself, mid-caps are then trading at a discount to large cap companies, which is not something that is unprecedented. However, it is something that is relatively rare. And if we think back to the last 20 years, let's say, the periods of time where UK mid-caps have traded at a discount to UK large caps have been 2008 and 2020, to pick two of the most obvious ones. So it tends to happen when the sentiment is negative and there are significant concerns about the economic outlook. And to come back to that final point about the narrative is negative, I think the reality when we look at actually the economic data is the UK has been experiencing an economic upgrade cycle. So the outcome in terms of the UK's economic performance has been better than had been anticipated pretty much throughout the last year and a half. And what we're seeing today when we look forwards from this point is most of the lead indicators are indicating that the economy is in fact strengthening rather than weakening. So I think actually it's quite an interesting inflection point with potentially better times ahead. And that should, of course, directly influence mid-caps, given their greater economic cyclicality.
And in terms of, what you were saying about the negative perception towards the UK stock market, obviously that's about the UK economy, but it's also about a range of factors, I guess, that have been discussed quite a lot. What do you think it will take to sort of give it a boost, if you want? And maybe considering we're getting a general election soon, is there anything you would like to see the government doing on that front?
I don't think it's a coincidence that we have seen outflows from UK equities pretty much consistently since the middle of 2016, where there was a rather significant referendum, of course. However, I think what drives a lot of the nervousness and some of the negative sentiment towards the UK market at the moment is just that perception or the changed perception from one of stability to one of instability. And that clearly hasn't been helped by the political landscape, whatever one's views are of the benefits or the disadvantages of membership of the EU, or which side of the political landscape one sits on. Change and uncertainty is something that financial markets really hate, and there has been clearly quite a lot of that over the last few years, and in particular with a certain amount of changes at the top of government that have taken place over the last 2 years in particular. So I think in terms of what could change that perception, a lot of it, I think, is just about the lack of change, i.e. more consistent output from politicians and more consistency so that everyone understands the playing field on which we're operating and therefore, if you like, sort of the rules of engagement. And so I don't think it particularly matters at this point, actually, who is in government, whether it's Conservatives or whether it's Labour. That is not always the case. And of course, at a micro level, it will matter for specific companies, et cetera, depending on the different political parties' policies. But actually, what we need to see is a period of stability so that people can almost put the political risk to the back of their mind as opposed to it being front and centre. I think also in terms of what we would potentially like to see from any government is, of course, we would like to see changes that can potentially make it more favourable for UK companies to choose to list in the UK, because one of the phenomena that I'm sure everyone is familiar with is the fact that the number of companies choosing to list in the UK has been declining over the long arc of history, as companies primarily choose to stay private for longer, but also as some companies have chosen different markets in which to invest. Now, some of those are potentially structural changes that are not necessarily within the control of the UK, but some of those could be slightly in the control. So, for example, there's the review of the listings regime at the moment to look at ways to make it easier for companies to list in the UK. And I think on the margins, things like that can help. And then, of course, we have to think about the demand side and whether any government can make changes that encourage either individuals or institutions to invest more within the UK equity market. And lots of people will be familiar with the fact that, for example, UK pension fund allocations have gone from being roughly 50% of their assets invested in UK equities only 25 years ago, to a low single-digit figure today. Clearly, if there are changes that can be made there that can encourage greater investment into our domestic market, that can also help.
Yeah, of course. And in terms of, I guess, your own attitude towards it, if you want. So I was mentioning the gearing before. Is there anything that would potentially prompt you to reconsider, if you want, on that front, to ease it back? Are there any red flags that you're looking at that would make you go, wait a second, maybe that's too much?
It's always a live debate, the level of gearing. So it's never set in stone, today what the gearing will be tomorrow. And actually, if we look at the gearing of the trust today is around 15%. Which is right at the higher end of history. If we think back to sort of the last 10 to 15 years, in fact, over the last 10 years, the gearing's averaged about 4%. So it's clearly at the higher end there. That is very much driven, and the way we put the portfolio together, it's very much based on bottom-up stock selection. So a lot of it is a function of the fact that we are finding more investments in companies that we want to buy than those that we want to sell. And I think that's always quite a healthy indication for the trust, rather than it being set on a sort of top-down view of we should be 10% geared or we should be 15% geared. It's based on the individual opportunities and how those come together. But of course, we're also thinking about what are the potential big risks on the horizon. Do we need to think about altering gearing or altering the construction of the portfolio in anticipation of those? As lots of people will be aware, this is a big year for elections, not just in the UK, but also more widely geographically, with 40 to 50% of the world's population voting. So clearly there are lots of moving parts from a political perspective, and there are lots of geopolitical concerns that have got sort of become more front and center over the last few years, particularly with respect to what's going on in Europe, specifically the war in Ukraine and how things there might develop and how that may, of course, influence markets. What we're focusing on today is the individual opportunities that we see for companies in the portfolio and whether those are incrementally getting better and more attractive or getting worse and less attractive. And at the moment, it's definitely the former.
Which actually brings me to a question I was going to ask, in terms of, how do you, I guess, define quality for the companies that you are looking to invest in, and what kind of metrics you look at when deciding to invest in a stock.
So the investment process is absolutely grounded in fundamentals. So as I said, it's looking at individual companies, and what we're looking for when we think about investing in structurally strong businesses. First of all, we spend quite a lot of time meeting management teams. So my team meet around 350 management meetings a year. So that's pretty intensive. And that's an important part of the due diligence. And one of the things we're looking to understand there is obviously the management team that are running that business, how they are thinking about the future and where they're thinking about investing in the business to drive future growth, because that is our key, one of our key focus points is, first of all, the capital discipline, but also the returns on that capital that can be achieved. So in terms of financial metrics, we care about the return on invested capital, both at a existing group level, but also on an incremental basis. As companies are investing new capital, what return can they generate on that? So that's thinking about return on invested capital, return on equity, and of course, key drivers that feed into that are what is the asset intensity of this business, but also what is the profitability, both at a gross margin level, but also at a net margin level. So, and then crucially, how does that profit, which is an accounting measure, how does that convert into actual cash generation? And the key, there is never one single metric, but if there were to be a single metric that we would judge companies on, it would be the amount of cash that they generate over time, because that is ultimately the best arbiter of valuation.
And very important for the dividend as well, naturally. You were talking about having, seeing a lot of stocks that you potentially might want to invest in. Can you say a bit more about that in terms of, the sectors that you're looking at, the kind of opportunities you're finding?
Yes, of course. So I think in terms of the big picture themes in the portfolio, and here I have to emphasize again, the portfolio is not built on this top-down view. It's very much individual stocks, and then that obviously comes together in the portfolio. And then, of course, we think about the portfolio construction. But if I were to think about changes in the portfolio over the last, say, 6 or 12 months, in aggregate, the amount of UK exposure in the portfolio has increased. By that I mean on a look-through basis of the portfolio, how much of the revenue is generated domestically. So over the last 12 months, that's gone up from around, I think, 50 or 51% to around 56% today. So that's quite a clear tilt in favor of domestic exposure. And I think that very much plays into the fact that we see the UK economy on a recovering trajectory. So clearly, from a pretty challenging start point, but on a recovering trajectory, i.e. things getting incrementally better. And then from a sector perspective, the area where we have clearly added the most exposure to, again, over the last, say, 6 to 12 months, has been into the more consumer discretionary parts of the portfolio. So, for example, to give some individual examples, one of the big areas of change last year, or reasonably significant area of change last year, was an increase in our housebuilders exposure. So that's gone from being around 4% of the portfolio to around 8% of the portfolio over the last 12 months. And big names in there for us are Bellway, which is one of our top 10 holdings, has been a holding for quite some time, but one that we added to quite materially at various stages last year, but also a new investment in Vistry, which is another house builder, but one that's transitioning towards more of a partnerships model. And then, of course, we have an investment in Redrow as well. So house builders has been one of the sectors in which we've increased our exposure, but we've also increased our exposure in other consumer areas such as travel and leisure, specifically new investments in companies such as Trainline, which obviously operates the Trainline app in the UK, but also internationally across Europe. but also in Jet2, which is the airline and tour holiday operator business. So a number of areas. That is in the context, I guess, that the portfolio is quite long duration in its nature. So last year, we only turned over around 20% of the portfolio. So we are making, so when I say a portfolio position has gone from 4% to 8%, that is quite significant because in aggregate, we are holding individual shares on average for around 5 years.
In doing that, in investing a bit more in what, if you want, are more cyclical businesses, isn't there a risk if you potentially are calling the recovery wrong in the UK?
Yes, definitely. So one of the things that we try and separate, but of course they're intrinsically linked. But one of the things that we want to think about is when we're looking at an investment, a potential investment for inclusion in the portfolio, we're always trying to consider what are the risk factors, what are the areas where it could go wrong. And for a number of investments that are in the consumer discretionary space, one of those top lines, of course, is actually the direction of travel for consumption. Is it moving up or moving down? Those investments that when we look over the long period of time, that we tend to favor are those where a greater element of the future is within the control of the company, i.e. it is less dependent upon the macro environment. And so I think a really good example of that, for instance, would be one of our largest holdings in the retail space. So of course it's consumer, it's discretionary, but this is a company called Dunelm, so home furnishings. I'm sure everyone will be familiar with it. But when we look at Dunelm, over the last 5 or 10 years, and in fact, even if we go further back, around 85% of their growth has been from market share gains, i.e. driven by them having a stronger customer proposition than competitors, and so they continue to take market share. So actually the majority of the growth that they can deliver comes from actions that they are taking rather than being dependent upon the macro environment in which we happen to be sitting today. That sort of an investment, I think, should have much greater duration in the portfolio, and we can have much greater confidence that we are making the right call than necessarily it being at the behest of the macro, which of course could change one way or another.
Yeah, no, that makes sense. I wanted to ask you about another one of your consumer discretionary companies, which is 4imprint, which is a promotional merchandise group. And the reason I wanted to ask you about it is because I think it's up like 40% in the year to date, and it has had a very good run basically since the end of, since the pandemic, if you want. So, do you think it can maintain that momentum? I guess the question kind of is if the fundamentals support the growth of the share price.
Yes, I mean, one of the things that I find interesting about 4imprint is quite how well, and you mentioned it, but quite how well they've come out of the pandemic. And this is a business, so for anyone who's not that familiar with it, because it's not that well known a business, this is a business that makes promotional materials that are typically used by corporates. So my water bottle at work, which has my company branding on it, could easily come from 4imprint. Similarly, the corporate logo on this pen, etc. So these are not high value items, but they're purchases by corporates to promote their brands. And of course, that can go up and down with the cycle. The really interesting thing about 4imprint, a little bit like Dunelm that I mentioned before, is actually quite how steady their growth has been when we look back at time. And of course, their sales cratered in the pandemic and then rebounded really, really strongly after the pandemic. But if we look over the long period of time, they have consistently grown their top line at around 10% per annum in a category that has clearly not been growing at that level. So they have been consistently taking market share. They are one of the larger operators in an incredibly fragmented market. And the advantage that gives them is their marketing efficiency, i.e. their own the returns that they generate on their own marketing to try and acquire customers is far greater than any of their competitors. And so they have, through the pandemic, significantly changed the way they try and acquire customers. So they've moved away from what they used to call their blue boxes. So the boxes of promotional material that they would send to corporates and try and generate sales through that. They're spending a lot more online, both in direct marketing, in terms of just trying to target specific sales. So in other words, pay per click on Google Ads, etc., but also bigger picture brand marketing, because they believe they have reached a scale whereby that brand marketing can generate an actual return. And that pivot in their marketing spend has seen their growth surge quite significantly, but the returns on those marketing dollars has jumped up massively, and that has fed through into a significant improvement in their profitability. So their profit margins have gone up significantly through that period. So for every dollar of revenue they make, they're now making a lot more profit, which converts into cash, which they can either reinvest or give back to shareholders. And that has, of course, been reflected in their valuation as the market has appreciated that coming through. But when we look at the outlook today, I think there's further for that to run, and that continued growth trajectory, I think they can continue on that growth trajectory looking ahead.
You were talking about the house builders before, because you've added to them. I guess why specifically the house builders?
Yeah, so one of the things that was particularly interesting, I guess, as we went through this rate hiking cycle, was our observations on the housing market. And through last year, number of transactions in the UK, as interest rates moved up and so mortgages became more expensive for the average consumer, et cetera, affordability came under pressure. And the risk in that scenario was that house prices would suffer a major correction. And of course, if you're a house builder and house prices collapse, that's extremely negative for their economics and for their returns. And so going into last year, like the rest of the market, we were obviously pretty nervous that that would happen. But it was quite clear that with transactions under pressure, the P&Ls of the house builders last year were going to be eviscerated. So they weren't going to be able to generate attractive profits in last year as a single year. But the bigger concern was, if house prices have structurally come under pressure, is the future economics of this business also impaired because of their land bank that they bought, assuming a certain house price? And so that was the main risk. And what we knew from our conversations with the house builders was that to get any material impairment on their land, on their NAV, we would need to see, it varies from house builder to house builder, but we would need to see something like 15 to 20% nominal fall in house prices. Now, bearing in mind what's happened to inflation, that would equate to a very significant real fall in house prices. And as we moved through last year, the probability of that significant fall occurring diminished in our eyes, because the house market did correct somewhat, but it wasn't a large or significant drop-off. So it looked to us like the tail risk of a major collapse and therefore a major impairment was diminishing. So the probability of a major impairment was diminishing, and yet the house builder share prices continue to come under pressure, to the point where Bellway, which is our largest investment in the space, was trading at around 35% discount to its book value, which is not that far off where it reached in the nadir back in the GFC. So for us, that clearly indicated that the shares were discounting a significantly more negative outcome than looked likely at that point in time. So that explained why we increased our position in that name in the middle of the year, and then again as we moved through the balance of 2023.
I guess moving on to a bit of a different sector, another holding I was very interested in discussing with you is 3i Group. A lot of the listeners will be familiar, but 3i Group is a massive private equity investment trust that is up about maybe 60% on a one-year basis. And unlike the vast majority of investment trusts, it's actually trading at a premium, quite eye-watering premium of maybe 40%. And this has quite a bit to do with its biggest holding, which is a retailer called Action. Guy, I guess the question I have for you is whether it has gone up too much. Like, can you keep going, basically?
So to put some, I guess, context around our holding in 3i, so this was an investment that we made in 2013. So it's been in the portfolio for, I guess that's 11 years now. So that is one of the longer term holdings. That doesn't make it atypical in the portfolio. It is also a top 10 holding. So this is a large position for the trust, and has been a large position for quite some time. Exactly as you say, Val, last year the shares did tremendously well. And that was off the back of, I guess, a combination of two factors. So the starting point of last year was, to our minds at least, a very lowly rated stock. So, in particular, the stock came under a lot of pressure around the time towards the end of Q1, when we were going through that sort of US regional banking crisis with SVB collapsing, et cetera, et cetera. And the shares came under significant pressure. So I think it's fair to say the starting point was very low. And then what happened through the year is the shares did tremendously well as both the net assets increased in valuation, and then the multiple that the market's willing to pay on those net assets increased. So the shares re-rated to, I think when I looked at them the other day, I think they're currently trading on about 1.3 times their book value, but on a prospective basis, it comes down to about 1.2 times. So they have re-rated, but a lot of the return driven by that growth in net assets, the key driver there being the really strong performance of Action, which is the discount retailer that makes up roughly 2/3 of their asset valuation. And I guess the thing about Action that has been most impressive has been not only the pace of the rollout of the stores across continental Europe, which has been, quite frankly, phenomenal, but also the sustainability of their like-for-likes. Because obviously for any retailer, the key to long duration profits and growing profits is the ability to grow sales density within existing stores. So growing their like-for-like sales. And they have managed to achieve that in a number of different price regimes. So yes, they achieved like-for-like sales growth whilst prices were increasing because of inflationary forces, but they've continued to increase their like-for-like sales in a period in which they've actually been deflating prices. So they've been putting their prices back recently, and their growth has been entirely volume driven. And that is the healthiest form of growth as far as I'm concerned. So that gives me a lot more confidence in the sustainability of the business as it matures, their ability to keep growing those profits over time. And then I think in terms of, are there still legs left to the Action story? I find it quite interesting to note that 3i itself has been increasing its ownership of Action over the last year, as opposed to decreasing its ownership. So clearly the view, this doesn't mean it happens, but the view inside 3i is clearly that the outlook for Action is still incredibly favorable. Otherwise, they wouldn't be buying more shares of it today, which is effectively what they've been doing. Looking across the 3i portfolio more broadly, they of course have a number of other assets, some of which are doing well, some of which aren't doing quite so well. But in aggregate, I think it's really interesting to see the aggregate stats in terms of the high percentage of portfolio companies which are still driving really significant profit growth. So I think in totality, as a business or as a portfolio, it's performing really well, which is why, quite frankly, I'm happy to leave it sitting there as very firmly in the top 10 holdings. And I've held it for the last 11 years. I hope to be able to hold it for the same again, quite frankly.
Yeah, so quite a bit of optimism there. I think one of the other things that always tends to come up, in the last year or so is obviously artificial intelligence. I wanted to ask you, if it has had any impact on the portfolio yet, if it's something where you see potential opportunities, potential risks, maybe a bit of both.
Yes, I think ultimately it is going to be a bit of both, because there will be, as with any other great sort of structural change, which this will, and this will count as one of those, there will be winners and there will be losers. And at this point in time, for many companies, it's too early to say which of those it will be. There are certain industries that I absolutely expect to be more challenged as a result of this. Those that are, quite frankly, ripe for automation, and where we can see that automation can come and cause serious problems to those businesses. But there are others where it could be fantastic opportunities for growth. And at this point, most businesses that we talk to, and it's obviously a topic of lots of conversations, are still in the more exploratory phase of that journey. But there are, if I pick just a couple of our larger holdings, which are in the tech space. So if I think about, for instance, Softcat, which is another top 10 holding, It's a company that we have owned, again, for quite a long time. We bought it at its IPO, which was, I think, back in November of 2015. We've owned it since then. This is a technology business which acts as they are a value-added reseller. So they act as the sales channel on behalf of the technology vendors in the UK to sell to mostly mid and small-sized corporates. And what they are seeing is incrementally more demand for technology based on some of the early AI solutions available, but it's something that they expect to be a gradual tailwind for their business over the years to come in terms of additional demand, rather than being a step change that comes in next week or next month. Of course, the release of Microsoft Copilot, et cetera, those are going to be incremental opportunities, but I think it'll just be an additional tailwind for that sort of a business.
And I guess going back a second to the state of the UK market, if you want, one of the things that always comes up, and we haven't really discussed it yet, is M&A activity. Has your portfolio been impacted by it? Do you think there will be more of it potentially?
So in terms of within the portfolio itself, we've had one approach. We've had two approaches so far this year, but one which is unlikely to come to anything, and one which is working its way through at the moment. So as I think I mentioned before, we own a couple of house builders, and one of those is Redrow, which is being acquired by Barratt. So that's a within market acquisition. Last year, one of our holdings, a company called Ergomed, which is a healthcare services business, was taken private by private equity. Generally speaking, I would say we under-index on M&A activity in terms of incoming activity into the portfolio, a lot of which I think is due to the fact that the types of businesses in which we're investing, I think they're very attractive businesses, but they tend to be performing pretty well. And a lot of what we've seen in terms of the sort of take private activity has been companies that have potentially been underperforming operationally or have been under pressure for other reasons, are more susceptible to a bid from private equity. That being said, I expect to see more activity going ahead. There's clearly a lot of eyeballs looking at the UK because of some of those arguments I made before in terms of where we are in terms of valuation, et cetera, but we can just see that in the statistics. So I think year to date into the UK market, there have been approaching, I think the number was about $45 billion of bids in terms of deal value for targets greater than, I think, a market cap of about 500 million. And that number that's a year-to-date figure, and that is larger than all of last year, as an example. And we're only a third of the way through this year, roughly. So clearly activity is picking up. And I think when we look back over the last 25 years, say, on average, 6% of the FTSE 250 has been acquired per annum. And it's roughly the same. It's maybe 7% for FTSE small cap. And that compares with around 2% for the FTSE 100. Of course, there are many more potential buyers for smaller companies than there are larger companies. And we see that in the statistics. And if you think about, 6% of the benchmark or the index being acquired per annum, and on average, those acquisitions come at about a 30% takeover premium, that's quite a significant delta versus, say, the FTSE 100, where it's only 2% getting that 30% takeover premium. So that equates to around 140 basis points of additional performance per annum, just due to that M&A factor, if you call it that. And looking to this year ahead, I expect it to be a pretty significant year for continued M&A.
Do you think is that potentially bad news for the market, for the UK market? Because obviously, if there are no IPOs and a lot of companies get bought up, it's not great, is it?
Yeah, de-equitization is a long-dated theme, and the UK market used to have significantly more companies listed in it than it does today. So absolutely, what I care about actually is I don't go to bed at night hoping that I'm going to wake up in the morning and see a bid for a company in the portfolio. What I would far rather happen is, lots more exciting companies choose to come and list in the UK. And I think we're at the early stages of that. That activity is cyclical, and there have been periods, and I know it's easy to be down about the number of IPOs in the UK, but if we think back over the last few years, there have been periods where there have been significant issuance activity. If we think about during the pandemic, the equity markets were absolutely there, providing capital to businesses that need it. But then coming out of the pandemic, there was a large number of new issues, and we participated in some of those. We're very selective in what we do, but we did participate. And what we're seeing today is companies beginning to come and look at the market in terms of some sort of early look or tentative meetings. And I expect maybe as we get towards the end of this year, maybe we need to get past the election. I'm not sure, but once that happens, then I am optimistic that we'll see more companies choosing to list in the UK, and that'll provide us with some of those future opportunities to put in the portfolio.
Mm-mm. One of Mercantile's targets is obviously growing its dividends for shareholders. Has it become harder to find companies that are able to do that? Are you maybe seeing more focus on other ways to return capital? There has been a lot of conversation about share buybacks, obviously, in the bigger picture of the UK market.
Yeah, it's an interesting debate because, first of all, my primary objective is long-term capital growth, but we absolutely look to deliver this dividend that grows at least in line with inflation. And actually, if we look back over, I think it's the last 30 years, the dividend that Mercantile pays out has grown at a compound rate of 8%. So well in excess of inflation. And actually, one thing I've been really positively surprised by over the last couple of years is how quickly the income that we receive in the portfolio has recovered coming out of the pandemic. That was really encouraging. And I think it leans partly into the type of companies in which we invest. So highly cash generative businesses that tend to be growing. So hopefully we're giving ourselves a bit of a head start there. But one thing we are seeing more of is companies leaning into share buybacks as a mechanism to return excess cash to shareholders. Whereas possibly historically, they would be more inclined to do special dividends. So this is very much about excess cash. This is not sort of what they do with their standard earnings. If you think of it, they generate earnings, they may pay a certain percentage of that back to shareholders as an underlying dividend. Hopefully they then reinvest the majority of it to drive future growth, but it's what they do with cash after those two priorities. And we're seeing more share buybacks. And I think that reflects the fact that most management teams look at their own shares and think they are probably the best incremental investment for them to do with their cash because the shares are undervalued. So it is generally seen as a positive signal as management teams themselves view their shares as undervalued. And this is the way to best demonstrate that.
We talked quite a bit about the company's shares being undervalued, but I guess we should also mention that Mercantile's shares itself is also undervalued because of the discount, which is not an uncommon thing because it has been quite widespread across the investment trust sector. First of all, what is the trust's approach to the discount and potentially to buybacks? And then I guess more broadly in the investment trust sector, what will it take for investment trust discounts to narrow? It has been going quite a while at this point.
Yes, so discounts across the sector widened quite dramatically, of course, over the course of 2022, from an average of trading around par to, I think, a mid-teens discount on average. And of course, there's a certain sort of bifurcation within that between, I guess, the sort of infrastructure assets versus equity investment trusts, which weren't quite as hard hit. But absolutely, Mercantile was caught up in that. As the sentiment towards markets in general became very negative, we see that with discounts tending to widen. But again, as sentiment has started to improve, discounts across the sector, but also for Mercantile specifically, have come in a little bit. But as you say, they're still sitting at quite wide levels. In terms of, I guess, the Mercantile approach to the discount, first of all, the board have the ability to buy back shares, which they do. There is no specific target or rule-based system, if we call it that. but they are there and ready to buy back shares as and when required, is I think the phrase that they use. And they have been buying back a certain amount of stock through I guess the fourth quarter of last year and a little bit through the start of this year. There was a certain amount of buyback activity, but relatively modest in the grand scheme of things, I think. What will it take, I guess, for discounts across the sector to narrow? Will be, first of all, I think, just improving sentiment towards the markets and specifically towards the individual asset classes that this represents. But also there has been a little bit of corporate activity. And I think if there's more corporate activity, that's something that can shine a light on some of the cheap opportunities that the investment trust sector presents. Of course, personally, if I were buying shares in any investment trust, I would always like to buy them at the biggest discount possible, because then you're buying assets that are worth 100 and you're buying them at 90 or 80 or whatever the number is. So it clearly does present an interesting investment opportunity.
Guy, this was all very interesting. I'm afraid it's all we have time for today, but thank you so much for coming on the podcast. Thank you to our producer, Maddie Athorpe, and thank you for listening.
Great, thank you.